Okay, let's unpack this. We're launching into a deep dive on Zions Bancorporation, that's Z-I-O-N, and their Q3 2025 earnings call. For you, the informed listener, the mission here is, well, it's pretty clear. Navigate the tightrope walk management had to perform this quarter.
That is the perfect way to put it. A tightrope walk.
Right. Balancing the stellar core operating results against a sudden, sharp, and very scrutinized credit event that hit right before the call.
Exactly. I mean, Zions really had to prove that its underlying business, the actual engine of the bank, was healthy enough to shrug off what was basically a massive punch to the gut.
And did they succeed? The market seems to think so.
It looks that way. The initial reaction, with shares moving up almost 3% after hours, suggests they did. They succeeded in isolating that shock and, really confirming the strength of their fundamentals.
So let's start there with that fundamental strength. Looking at the numbers, this was a decisive beat. And that's crucial, especially given all the sector volatility.
It was a clean beat.
Yeah, GAAP EPS came in at $1.48. That beats the consensus, which was clustered around 145, 146?
That's right. And it wasn't just the bottom line. They delivered on the top line, too. Revenue hit about $872 million.
Also topping estimates.
And that represents a solid 8.5% year-over-year growth. For a regional bank in this environment, I mean, that growth rate is absolutely turning heads.
Okay, so we've got the beat. But how do they actually generate that strength? What numbers tell us the most about the core health before we get to that problem credit?
Well, you have to look straight at the bank's core operating engine. And for that, we look at pre-provision net revenue, or PPNR.
The money they make before setting aside funds for bad loans.
Exactly. It's what the bank makes from lending, fees, managing expenses, the whole operation. And that PPNR was significantly healthy. It grew 14% year over year.
14%?
And even 18% if you look at it on an adjusted basis. That's the engine running hot.
That PPNR expansion is a huge signal. If the engine's running hot, the market is, much more likely to forgive a temporary sputter. What about efficiency? That's always a concern for the regionals.
They delivered there, too. Their efficiency ratio improved to 59.6%.
So for you listening, that means the bank spends less than 60 cents to generate every single dollar of revenue.
Right. And in a period where margins are under so much pressure, that kind of expense discipline isn't just good, it's a major competitive advantage. It's what let them produce that positive operating leverage.
Let's dig deeper into that margin expansion, because that seems to be the real story here. Zions delivered its 7th consecutive quarter of net interest margin expansion.
Yeah, in M expansion, it's an impressive streak.
7th quarter.
It is a phenomenal run, especially because most of their peers are struggling just to maintain margins, let alone expand them. Yeah. Their M went up 25 basis points year over year, hitting 3.28%.
And management specifically pointed to that, right?
Oh, yeah. They highlighted that this strength allowed them to get 5 points of positive operating leverage for the quarter, which just means their revenue growth rate is meaningfully higher than their expense growth rate. They're getting more productive.
And it wasn't just on the interest income side. Non-interest income was also robust. We often hear about banks struggling to diversify, but Zions saw an 8% year-over-year jump there. What drove that?
The strength really came from their capital markets advisory business. They saw a whopping 25% increase in capital markets fees.
So that's things like loan syndications, swap fees.
Exactly. And this speaks directly to their local market depth. When you have those long-term relationships, you can capture more of that secondary service revenue, not just the initial loan interest.
Okay, but to sustain that NII and margin expansion, you need stability on the funding side. The market has been laser-focused on deposits. What did Zions show us there?
Strong momentum. Ex-broker deposits grew at a 7% annualized rate, quarter over quarter. That's a great indicator of sticky core funding. But the really fascinating detail was how they managed their deposit mix.
What was the magic trick there?
Well, it wasn't what you might expect, like a big jump in corporate non-interest-bearing accounts. They managed a really strategic mix improvement.
How so?
Non-interest-bearing deposits actually grew by $192 million sequentially. That's an 8% increase in that segment.
Wow.
And they did it by migrating a consumer interest-bearing product into a new, higher-value, non-interest-bearing consumer account.
So they actually convinced customers to move their money from an account they had to pay interest on to one where they don't.
Precisely. That shift is, it's essentially like printing a tiny bit of margin, and it's very effective. This mix improvement drove their total cost of funds down 5 basis points sequentially.
Bringing it to, what, 1.92%?
192. That ability to actively manage the cost of the money they lend out is a massive advantage in this REIT environment.
And this all translates directly into shareholder value. Tangible book value per share PBVPS grew 17% year over year. That's real capital generation.
That figure is a direct reflection of that PPNR health we were just talking about. It shows the intrinsic value being compounded quarter after quarter.
Okay, let's transition now. Let's get to the big test of management's narrative. That isolated credit shock. It dominated headlines, caused a sharp 13% sell-off before earnings. Lay out the specifics for us.
Right, the elephant in the room. So the issue centered on 2 related commercial and industrial, or C&I, loans. To deal with it, Zions took a $50 million charge-off on those 2 loans.
$50 million.
And then they added another $10 million specific reserve against the rest of the exposure. So a $60 million risk addressed in total. The provision for the whole quarter was $49 million, but it was almost entirely this one event.
So how did management defend this? Because $50 million is not small change.
They were adamant and very strategic in their language. Both the CEO and the chief credit officer strongly framed this as being an isolated event.
Isolated, that's the key word.
It is. They said it resulted from unusual things going on with a very specific set of borrowers, not a systemic failure of their underwriting. They even noted legal action is underway for recovery.
Which suggests they think they can claw some of that loss back.
At some point, yeah.
But does the rest of the loan book actually back up that claim of isolated risk?
That's the absolutely critical counterpoint they were able to make, and we can quantify it. If you exclude the total charge-offs from this one single incident, the $56 million, the remaining net charge-offs for the entire rest of the loan portfolio was only $6 million.
$6 million
Well,
on the whole rest of the book.
Exactly, which works out to a very benign 4 basis points annualized of average loans.
4 basis points.
That tiny figure directly supports their claim. The problem was focused on 2 bad apples, not a rotten barrel.
And during the Q&A, they also talked about NDFI exposure, right? Non-deposit financial institutions. That's been a stress point for some of their peers.
They were quick to put it in context. They noted NDFI loans are only about 3% of their total portfolio. And on top of that, it's highly diversified, mostly low risk, equipment leasing type stuff.
But then the CEO pivoted, and this is where it got really interesting. He pointed the finger outside the regulated banking system.
Yes, that was maybe the most provocative moment of the whole call. The CEO voiced major long-term concern over the massive growth and the comparative lack of regulation in the private credit sector.
Private credit.
His argument was that because of its size, its complexity, and most importantly, the lack of a liquidity backstop like the Fed, that unregulated space poses a huge, unseen, future spillover risk to the whole market.
So why do you think he's raising that alarm bell now? Is it just deflection or something more?
It feels like a genuine strategic concern. He's implying that while banks like Zions are heavily scrutinized and forced to disclose every single risk like they just did, there is this gigantic pool of credit risk building up in the shadows with far less transparency.
So the message to an investor is clear.
Very clear. You should be focused on the hidden risk building up outside our walls, not the one isolated event we just fully disclosed to you.
Okay, so given this one specific failure, did they talk about changing their credit process?
They're initiating a third-party review, which is standard procedure, just to see what lessons can be learned. But they did reiterate that their credit decisioning stays decentralized.
At the affiliate level.
Right, which they see as a local strength. But it is centrally monitored, so the chief credit officer has oversight on all the major risk decisions.
Okay, we've nailed down the past quarter and the credit shock. But investors always look forward. What does the forward guidance tell us about the next 12 months?
The guidance was generally cautious but positive. They expect moderately increasing net interest income, moderately increasing expenses, and moderately increasing loan balances. The key takeaway, though, is where that loan growth is coming from.
And I assume that means shifting away from commercial real estate.
Exactly.
Yeah.
Their expectation is that commercial loan C&I will be the primary engine of growth over the next 12 months, not the heavily scrutinized commercial real estate or CRA segment. It's a proactive risk management shift.
And how do they plan to keep that positive operating leverage going while also investing?
Management was clear that continued investment is essential in tech, in revenue businesses, in marketing. But their firm expectation is that revenue growth is still going to significantly outpace expense growth. That's the whole game right there.
Let's revisit that margin. They've hit 3.28% in IM. What is the long-term target?
They reiterated 3.50% as their long-term strike zone. That's the comfortable range they aim for.
But they were cautious about the timing.
Very cautious. Their internal guidance now factors in a potentially lower rate environment. They're assuming 4 total Fed cuts by July of 2026. And that, of course, means hitting that 350 target will take more time.
What about capital management? They have a strong CET1 ratio of 11.3%. Are buybacks close?
Not immediately, which, disappoints some. They're focused not just on CET1, but on total capital, including the impact of AOCI. Management indicated a buyback program is still roughly 12 months away.
So safety first.
Safety and normalization over immediate shareholder returns, yeah.
The M&A, the big question that hangs over every successful regional.
They're open to it, but selectively. They said they're only looking at smaller, market density enhancing deals, things that bolster their existing footprint.
And the CEO said they felt no compulsion to do a deal.
Exactly. He made it clear they won't do a deal just to do a deal. It has to be a perfect strategic fit with no dilution.
Last thing, what is the CEO's take on the regulatory environment?
He was supportive of what he called a regulatory focus back to basics. He argued that a lot of recent regulations, he cited climate disclosures, are trivia and a major distraction. He wants a focus on core safety and soundness.
So synthesizing all this, the 13% pre-earnings sell-off on the credit news, followed by the positive reaction after the call. What message is the market sending?
I think the recovery signals a successful separation process. The broader regional banking index was struggling, down over 6% in October because of this generalized systemic fear.
Right.
But the market looked at Zions facts and concluded that the $50 million loss was truly idiosyncratic, a specific failure with 2 borrowers, and not a sign of systemic erosion in their portfolio. The long-term thesis is still intact.
Okay, here is where we remind you that everything we discuss is for informational purposes only. This is not financial advice. You should always do your own research.
And with that disclaimer firmly in place, let's talk about the outrageous but plausible trade idea that comes out of this call.
Pitches the trade.
Long Zion. Initiate a long position, betting on the market fully recovering the recent volatility, and then applying a higher multiple to the confirmed core earnings power. The outrage here is that we are betting against sector-wide fear, based purely on the specific, isolated facts from this one company.
And what's the rationale that supports this aggressive bet?
The rationale is simple. Management successfully isolated the credit risk. The core engine, that 18% adjusted PPNR growth, the 7th straight NIM expansion, the sticky deposits, it's all fundamentally intact.
And you think that engine is undervalued?
Significantly undervalued, yes, due to the generalized discount on the entire regional bank sector.
So we're betting on the rebound and a multiple re-rating. What's the target?
The target is a full retracement of that recent 13% drawdown, plus the post-earnings appreciation. This projects the stock to trade above its immediate high of roughly $53.45 in the next 90 days.
That's a deep dive into the Zions Bancorporation call. In summary, a clear beat driven by impressive core profitability, and they successfully navigated a sharp but temporary credit shock. Key watch items going forward will be that follow-through on the loan growth shift and maintaining that expense control.
And here's the final provocative thought for you to mull over. Given the CEO's stark comments on private credit, should investors be spending less time obsessing over these one-off, well-disclosed credit issues inside the banking system, and far more time focused on identifying hidden, unregulated spillover risks building up outside of it?
Food for thought indeed. Thank you for joining us for this deep dive into the source material. We encourage you to explore these concepts further.